Hello everyone. As we do at the beginning of each quarter, let's take a look at the main conclusions that can be extracted from our digital top-down methodology. Our methodology consists of evaluating the attractiveness of European equities based on 4 complementary pillars of analysis. The first pillar focuses on the economic momentum for growth in Europe. Our proprietary indicator remains anchored at a level close to all-time highs, despite the weight of international political events. The opposite is true in the United States, where economic momentum is under pressure. We believe that this is a temporary phenomenon provoked by the new administration in order to force the Fed to lower rates significantly. The second pillar covers the ECB's monetary policy. In the space of 12 months, the ECB lowered the deposit rate from 4 to 2%, the current level of inflation. Investors expect this rate-cutting cycle to come to an end during the first half of the year, with a single 25 basis points cut now anticipated. Meanwhile, the US Fed may well surprise on the upside, as its policy rate at 4.5% appears far too high in relation to US inflation, currently at 2.4%, and in comparison with the ECB's accommodative policy. The third pillar of our analysis deals with valuations. The European equity market risk premium is close to the average observed since 2000, while the small and mid-cap segment is discounted by around 10% by historical standards. In this context, it would not be surprising to see the small and mid-cap segment continue to outperform in the second half of the year, with the aim of normalizing the valuations of the various compartments of the European market by capitalization size, both in absolute and relative terms. Finally, the fourth pillar tackles the behavioral aspect. The trend on the international stock markets remains powerfully bullish, particularly in Europe. We also continue to identify attractive technical configurations for the European small and mid-cap segment, both in absolute and relative terms. After a rise of more than 50% in European stock markets over the past 3 years, it may seem legitimate to question the sustainability of the current rally. However, we believe it is still too early to reduce strategic exposure to European equities. Our economic momentum indicator continues to signal a favorable environment for the asset class. Monetary accommodation by the ECB, far more powerful than that currently being implemented by the Fed, remains a supportive factor. Valuations do not reveal any excesses or even a significant undervaluation of the small and mid-cap segment, which could support the relative performance expectations of active managers. All this is taking place in a momentum that remains bullish for European equity indices at this stage. That's all for today, and we look forward to seeing you at the start of the next quarter for another market review with Shaheen Capital. Thank you.